Article 60, Capital Assets Scheme. Capital assets are significant long-term assets acquired or imported for business use, typically utilized over several years and not intended for immediate resale. Since VAT is paid on the purchase or import of such assets, input tax recovery is adjusted over their useful life based on actual taxable use under the Capital Assets Scheme. 1. Requirement to assess and adjust input tax. When a capital asset is either purchased locally or imported into the state by a taxable person, that taxable person must. The asset's intended use and expected period of use must be determined, and the Capital Assets Scheme applied to adjust input tax recovery over that period. The goal of the scheme is to ensure that the actual taxable use of the asset over time is reflected in the amount of input tax recovered. 2. Period of use and tax adjustments. Under the Capital Assets Scheme, input tax recovery is not fixed at purchase but is monitored and adjusted over the asset's useful life. If the use of the asset changes over time, for example, shifting from fully taxable use to partly exempt use, the recoverable input tax must be adjusted accordingly. This ensures that the taxable person only recovers input tax proportionate to the taxable use of the asset. 3. Obligation to maintain capital asset records. The taxable person is required to maintain complete and accurate records relating to all capital assets. These records must be maintained for a minimum period of 10 years and should include purchase or import invoices along with details of the asset's intended use. They should also contain annual usage reviews indicating whether the asset was used for taxable, exempt, or non-business purposes. In addition, records must include calculations of input tax adjustments under the Capital Assets Scheme and all supporting documents related to such use and adjustments. 4. Executive Regulation Provisions. The executive regulation of this decree law will specify detailed rules and conditions regarding the Capital Assets Scheme, including a. Definition of capital assets. The regulation will define which assets qualify as capital assets for VAT purposes, typically including buildings, major real estate, machinery, equipment, and large business vehicles. It also covers other long-term investments that qualify as capital assets under applicable accounting standards. B. Estimated useful life. The regulation will define the useful life of each type of capital asset, and the input tax adjustment period will correspond to that defined duration. For example, real estate may have a useful life of 10 years and machinery or equipment 5 years, with input tax adjustments applying throughout the respective useful life period. C. Method for adjusting input tax. The regulation will prescribe how to calculate annual adjustments by assessing actual taxable use against the initial intended use and adjusting the recoverable input tax accordingly. For example, if an asset initially used entirely for taxable purposes is later partly used for exempt activities in year 3, a portion of the previously recovered input tax may need to be repaid to the authority. D. Extended record-keeping requirements. In certain cases, the executive regulation may require longer retention of capital asset records, particularly for assets with extended useful lives, those under audit or dispute, or high-value assets with significant adjustments. Taxable persons must comply with any applicable extended record retention requirements for such assets. For more details, contact us.